Welcome everyone to the CAI Greater Inland Empire Chapter interview about AB 1101 with Thomas Ware today. I'm Kimberly Lilley. I serve on the Communications Committee. And as I mentioned, we have Thomas Ware. He's a partner in Kulik, Gottesman, Siegel, and Ware. He's also legislative co-chair of the California Legislative Action Committee, which is a statewide organization that deals with legislation. And Tom's job, co-chair, he and one other person are in charge of making sure that the task forces are overseen, that information is gathered and positions are taken on bills. And that position and the messaging is communicated to our legislative advocate, Louis Brown in Sacramento. So Tom knows the scene. He's also lead on the bill AB 1101, which CAI-CLAC is sponsoring. So to start off, Tom, thank you for joining us today.
Thank you. I'm happy to be here.
Awesome. There is history here. We didn't just start in with AB 1101. So can you give us a little bit of the backstory?
Yeah, AB 1101 in essence is cleaning up a prior bill that CLAC sponsored about 3 years ago, AB 2912. And the genesis of AB 2912 is that there was a concern about protecting associations' finances. One, wanted to make sure the finances were transparent. There were transactions what would happen electronically. In particular, we were concerned about electronic transfers that the board might not be aware of because that was rife for potential embezzlement. And so that's part of what the AB 2912 was trying to address. And in addition, to make sure that in addition to making sure the boards were aware of these type of electronic transfers, so they wouldn't suffer embezzlement, in the chance they missed it, we wanted to make sure that associations were properly insured, because we found that there were a number of associations that didn't understand the type of insurance that they needed, or didn't have the proper coverage for the type of losses. So that's what AB 2912 did originally. So it did it in a couple things. One, it required that board members review their financial documents on a monthly rather than a quarterly basis. It also specified the types of documents that they should be looking at. And the purpose of where these documents came from was, when we look back at these fidelity claims, we could see, oftentimes you could see the theft on the actual financial statements. And if the directors were actually paying attention to it, they could have stopped it or picked it up earlier. So that's part of what it did. It probably specified what documents they should be looking at and the intervals that they should be looking at. And we picked 30 days in part because when you have if you have a forgery on your check, your bank basically gives you 30 days, in essence, to make a claim on it. And if you don't, you theoretically have waived your right to assert a forgery of that check. So that's part and parcel of what the 30-day was supposed to be doing. And in addition to that, we tried to make it clear, when we originally proposed the bill, we wanted to make sure that electronic transfers, that the board actually approved them. And I'll tell you in a second, that didn't end up in the bill the way we wanted it. But that was the point. We wanted to make sure that boards were aware when monies got transferred electronically, because we found that there was, as I mentioned before, that there was situations where people would be transferring money, oftentimes from the reserves to the operating account to cover thefts. And so, and even outside the accounts, people would make, ACH transfer, paying something purportedly, and the board had no idea that this was going on. So the idea was to make sure that the board was aware of that. And then the third thing it was supposed to do was to make sure we had the right of insurance, that they had the fidelity bond. We call it fidelity bond coverage, which we'll talk about in a second. And that it would have it in an amount that would make sure to protect the 3 months of the operating accounts, and then the total amount in the reserves. And to make sure that this coverage extended to the management agents as well as the directors and officers. So that's pretty much what AB 2912 was supposed to do when it was proposed. And then literally weeks before the legislative session closed, it got amended in the Senate. And when it was amended in the Senate, instead of just limiting requiring board approval for electronic transfers, the Senate took out the reference to electronic transfers and made it applicable to all transfers that were either $10,000 or more, or more than $10,000, or 5% of the total operating accounts. Now, and so that led to confusion because nobody knew, when did you measure the operating accounts, and what's the, when do we look for 5%? And so that's that, and the insurance aspect of it prompted some cleanup work, which is what AB 1101 is trying to do.
Okay, so originally this was to protect associations, even to the point of allowing them to recoup money with bad checks by keeping it within a certain time frame, which was thoughtful. So what does AB 1101 do to kind of fix some of the problems from the previous bill?
Well, the first thing it does is it addresses the insurance issues, because there was some kind of confusion created by the fact that, historically, there was these things called, I'm sure you're aware of being in the insurance industry, but there's things called fidelity bonds. And they were a type of bond, a surety bond that you got to protect against employee theft. And over time, different types of instruments of insurance were developed that could kind of accomplish the same purpose. There's employee dishonesty and crime loss coverage. And quite frankly, in the HOA world, most of the time, the policies that the HOA gets are the latter. They're not fidelity bonds.
We don't use bonds in the industry anymore.
Right. And so the primary thing we try to do is change the language and to make it clear that people that were getting the crime loss policies and the employee dishonesty policies, that was sufficient as long as it met the coverage requirements of the act itself, and also that it makes sure that they had the proper endorsements on it to cover the manager, the managing agents, and the directors and officers. Then the second thing AB 1101 does is it tries to eliminate that confusion that I mentioned before about, what's 5% and when do we measure 5% of the operating accounts. We took that out, or the legislator's taken it out, and it's basically going to have a flat fee number, and it's going to be tiered based on the size of the homeowner association. For example, if you have 51 or more members, then the board needs to have written approval of the transfer of $10,000 or more. And if it's less than 50 or less, the units, then the board needs approval when they're for any transfer of $5,000 or more. So that it tries to deal with the size of the association and also makes it more clear when approval is required, which I think will be helpful to people. And then the third thing it's going to do, which wasn't really part of what AB 2912 did, but while we were tweaking it, we decided to clear this up. The third thing it does is it talks about the type of bank accounts accounts that a manager can deposit association funds in. Currently, a homeowner association's manager can actually deposit association monies in either a bank or a credit union. But the statute says that those accounts have to be federally insured by the FDIC. Well, credit unions accounts are not. They're insured by a separate entity. So what we did is we clarified that you can still deposit in credit unions as long as you are compliant and you have that requisite insurance that covers credit unions. So that's pretty much what it does. I think it's overall, it's fairly simple, and it's consistent with the initial goals of AB 2912.
Excellent. So in that original choice to have accounts, funds put into banks and credit unions, as opposed to, say, risky investments, was to clarify the fiduciary responsibility of the board.
Right. And in fact, that's there is some language being added to AB 1101 that is clarifying that they have to protect these, wherever they deposit, has to protect the principal of the association's accounts.
Excellent. All righty. Well, thank you so much, Tom, for joining us. Grateful. Everybody, thank you very much for joining us for this interview on AB 1101.
Thank you.